Well, good morning, everyone. Looks like we've got people that are yet to get on board here, but we've got pretty good turnout for today's call or webinar. And I guess this is one of the classes I really enjoy presenting because I feel as though every time you list a property, you ought to think about what it is and what you really want it to be. And the title today is what are you selling? What do you want it to be? And what I mean by that is, if you look at a sale in today's world, you think about the sale of a primary residence, for example. I've been involved in the business, in the 1031 business, since 1991. And if we look at the tax law changes in 97 with respect to the sale of a primary residence, pre-97 you had something called Section 1034, residential rollover. You sold your home. If you're 55 or older, you had a one-time lifetime exclusion, $125,000 in gain. But if you just sold, you had 2 years to buy a new home of equal or greater value. So if you were going up in value each time, it was a good thing. The exclusion, if you're trying to get out, didn't do much for you. So when we had Section 121 replace 1034 in 97, the 250 personal exclusion on gain, the 500 married couple exclusion on gain meant something in 1997 dollars. Today, those numbers are not very good for a lot of people. And you can say, well, gee, they should be happy that the properties have increased in value so much. I think most of you out there probably agree that a lot of this increase in value is due to inflation too. So, I mean, I think about the first house. My background was real estate investment. I grew up in Santa Cruz, moved to Oregon in 1990. First house I bought in Oregon, my brother and I bought as an investment. It was a beautiful old Victorian, built in the teens. It was sort of in a rougher area of Salem, Felony Flats. It was the area, but we paid $23,000 for that house. And within a year we sold it. Actually, not within a year. Within a year it was improved to the point we'd only put $20,000 in improvements into it, but it was still worth about 85,000. And today I don't know what it'd be worth, but maybe it's 3, 4, 500,000 today. But I don't know. You think about the cost of things, where they've gone, and the exclusion when they were put in place in 97, 250, 500 meant something. Today we've got many people in anywhere. If we're looking on the West Coast, you've got gains well in excess of those numbers. So when you go to sell your home, you've got to look at what the exclusion offers you and see what you can do to keep your money yours. I mean, one of our business statements is always, you've worked hard for your money, we work hard to keep it yours. And so I put it out to you, when you're selling a property, really look at what that thing is and what's going to fit your situation best. What are you selling? What do you want it to be? And what I mean by that is, it might appear to be a residence, but it's not. It might appear to be an investment, but it's not. And we'll talk about what I mean about those two statements in a little while. And as far as the usage of the property, and then as far as completing an exchange, the same thing's going to apply. What do you really want to acquire? And understanding that it's possible to convert an investment property into residential property. It's possible to convert residence into investment to residence. So you're going to look at these tax codes, see what fits in, and what's going to fit your situation best. Now, with that said, I said you're going to do that, but we're going to say, you're on a call today that's being presented by Equity Advantage, and Equity Advantage is an exchange company. Well, you've got lots of people, professionals out there in your investment world that are very important. I'm going to put ourselves on that team, but I'm going to put competent, or not competent, but really a very good tax counsel is going to be one of the most important people in your life, because they're going to look at these codes. They're going to figure out what's going to fit your situation best. And you could have a single allocation, a single property, single allocation of one code, or it could be multiple codes. And most of the time, 9 times out of 10, you're selling something that's either residential or investment. We've said for now 3 decades that up to 64% of all properties on the market could or should be exchanged, and we'll talk about that. But the idea is, whether you've got this property that is a residence today, and you look at the gains, if the gains are well in excess of 250 or 500, well, maybe you move out, convert it into an investment. Well, as long as you sell within 3 years of moving out, you're still going to be able to take the exclusion. You've got that 2 out of 5 requirement. We'll talk about that a little bit more in the future. But when it sells, you could have allocations going both directions. On the acquisition side, we're going to buy something with the exchange that requires that you're buying something with the intent to hold it for investment. There's no stated required hold in the code. So you're going to work with those tax people once again. We're looking at tax law, very rarely the black and white answer on these things. There's lots of gray, so rarely a question whether you can or can't do something, is how you're going to get it done. So good tax people, finance people, you need to know what you're going to be able to buy, what kind of money you need. We have a sister company, IRA Advantage, that handles retirement accounts, put retirement money into things that Wall Street doesn't sell. A lot of those people are buying real estate. Well, if they want to go buy a piece of property with their IRA or 401k, it's got to be non-recourse debt. It's a different type of debt. The only thing the lender can do in a default is take the asset. So lenders are critical. You need to know what you're going to be able to do, how you're going to do it. They need to understand what kind of money you're looking for. And one of the biggest issues we've got, the biggest problem with any exchange is time. Second biggest issue is often going to be the vesting of the property. And the vesting issue gets to be very sticky very quickly. And an example I'll give you right now before we get into it is just a husband and wife in a non-community property state. If you are married and you've got an LLC for your properties, and you go forward into another property, you give up, relinquish in an LLC, you're going to have to receive the replacement property in that same LLC. Well, we might have set up the exchange in the LLC's name, just with spouses in it, like I said, and then you go to buy the replacement property. If it's 4 units or less, it's going to be a residential loan. The LLC is going to be more expensive to finance. So you're probably going to come to me and say, look, we want to take ownership personally for that reason. And I'm going to tell you, we can't do that. Now, if we're in a community property state, you can go in and out of the LLC. So these things, that's just one example of something that's simple, getting to be sticky. So when you contemplate an exchange, people ask all the time, when do I want you to think about it? It's a time of listing. This presentation is all about that, because you're looking at different tax codes, what it is, what you want it to be. And the deal is that you've got to really plan where you're going. Don't look at it at close and say, gee, I need to do an exchange at this point. Think about it when you list the property. Think about whether you want to do an exchange on that thing. At that point, it's going to require different things happen. The understanding of how long you've owned something. Imagine if you've owned a home and you bought that thing and you decide to sell it a year and a half after acquisition. Well, Section 121 does not offer prorations outside of hardship. So it's not an elective proration of the 250 or 500 that Universal Exclusion offers. The only time you're going to get a proration is in a hardship situation, which obviously in the time of COVID today, we've got lots of people with that situation that can probably justify what's going on. But that's the main thing, is understand what you've got, what you have, what you want it to be, where you're going, what you want to ultimately end up with at the end of the day. So that's what this class is about. We probably are not going to be addressing questions online. There is a menu off to the right. If you've got questions, please don't hesitate to put them in that place. If we don't address them during this class, I'll be responding to them after the fact. And if you are in a state where we can offer CE for real estate, please reach out to C Moore, CMOORE at 1031exchange.com. That's Celia. She will work with you on that side of it. She'll also be sending you out a link. If you have to leave the presentation day, this will all be online for future reference. And I would say, if you're a real estate broker, keep it in mind. I mean, if you're listing a property for somebody and they're sort of looking at what they've got, what they want it to be, take a look at our YouTube channels, Equity Advantage 1031 or IRA Advantage Self-Directed Retirement Accounts, and there's going to be lots of information on there. But if we can help you out, get things done, we're going to do it. So thank you very much for joining, and away we go. So, title, what are you selling? What do you want it to be? Proper application of Section 121 and 1031. I guess first off, we got to look at, why you should be looking at real estate today. I mean, think about it. We all hear the ads for gold and silver, palladium, those things, precious metals. We see the ads on TV. We hear them on the radio. And the bottom line is that they're talking about tangible assets as inflationary hedges. Now, I'm a real estate guy, so I would say the real estate is the ultimate tangible asset. If you're buying precious metals, and we've got lots of people come to us on the retirement side wanting to invest in precious metals, understand what that thing is and understand how it's going to make you money and understand what the quoted price is. Probably not going to be what you get for it when you sell it. So you got to really think about what this is, what you're buying, how you're going to use it, but you're still betting that it's going to go up in value. I mean, it's an inflationary hedge. Well, real estate, I always joke, I'm in the business of selling real estate to real estate people, and real estate doesn't have to go up, right? I mean, no matter what, you've got a situation where you've got a tenant, hopefully, if it's an income property, making payments for you, getting you where you want to go. And you're not banking on it appreciating. I mean, that's the deal. My mentors always taught me never to bank on appreciation. They wanted me to answer 3 questions before I got started. What am I going to make? How am I going to make that money? When am I going to make it? And if I couldn't answer those questions, don't do it. But I just love real estate. No matter what, you've got the cash flow going on. You've got leverage that's going to help you out. Sure, if you're in Wall Street, you can have a margin account. Gives you some equivalent there. Interest deductions, mortgage pay down, depreciation, appreciation. You've got all those things working for you during the time you own that asset. And it's just a beautiful thing. And I've got so many people that have started in the real estate investment world. Somebody's personal investment, personal property, their primary residence often is their first investment property, and they buy it when they're single or pre-kids, they have kids, they get the dog, the cat, now the place is too small, so they keep it, rent it out, and they go buy another property, and then they snowball it. And that's just such a wonderful thing. With 1031s, people ask all the time, well, how long do I have to own a property to have it qualify? There's no stated required hold in the code. It has to do more with what you're doing with the property during the time of ownership than the actual time of ownership. So what I mean by that is you could go out and buy a property. In today's market, it's not uncommon. I have one of the brokers we work with a couple of weeks ago. I think they put a property in the market, got 75 offers the first day. That's just unbelievable. But we're in a situation where we've got people buying properties, and somebody will knock on their door and say, gee, would you be interested in selling it? And I'll tell you that if that happens to you, and you take advantage of that situation once, that shouldn't be a problem for you, but you don't want to establish a pattern. As soon as you start looking at buying with the intent to sell, or just buying, fixing, turning, we all hear the ads, just like we do with the precious metals. We hear the ads for people flipping property. And the thing is, flipping property is a problematic deal in that it's not property held for investment. It's not going to qualify for 1031. Typically, you're not even holding it for a year, so you're paying normal income tax on. Even if you held it for more than a year, if you're working on just prepping it for sale, you're looking at normal income tax instead of long-term capital gains tax. Makes a big difference. And we've got we're in the world of acronyms these days. So I heard somebody talking about the BRRRR principle. Buy, rehab, refi, rent, and repeat. Well, that is a great thing, and that's really the way we learned to do everything 30, 40 years ago. I mean, it's a modified flip. You're buying things, you're fixing them up, you're increasing the value, you're pulling the money out via the refinance, which does not trigger tax. I'm going to take that BRRRR principle, take it a step further, because typically the investment life of a property is going to be 3 to 5, 5 to 7 at most. And that just happens because your equity increases to a level where the ROI does not work any longer. You've got 2 choices. Once again, do another refi or get rid of the property. And how do you decide between those 2? Well, I would say pull the money out if you can do something more with that property, or the old saying, never sell good real estate. That might apply too. But most of the time, you're going to get to a point where you've exhausted the potential in that property, and you're going to do an exchange out of it into something else. What we used to do is, buy, we rehab it, get it all rented out, take care of it, what we needed to do the refi, pull the money out, hold it for a year or 2, then do an exchange out of it into the next property or properties. So you're snowballing things. And sometimes people say, well, gee, why would you do an exchange? You're going to have to pay the tax at some point anyway. Why not pay it today? Well, tax rates potentially are going to go up, so that might be an argument to do it, to sell today. But you've got this inflationary period. The dollars just keep going, down value. So to hang on those tangible assets is going to be better for you. And ultimately, the wonderful thing through the years has been to do what we call swap till you drop. So you just keep exchanging, and at some point, when you pass away, your heirs are going to receive a stepped up basis in those assets, and they could turn around the next day and sell with no tax consequence. Now, understand, this is April of 2021. We are in a situation where we've got the current administration, Biden administration's really got their hands full with COVID, and actually it looks like all the racial relations right now taken with the court cases and everything. But the initial tax proposals were to either eliminate or modify 1031, eliminate the stepped up basis, increasing capital gains, normal income tax, so a variety of things that are going on. And if you go back through our video library, you're going to see a video that was presented in January on tax reform. It was what was proposed there. And the idea at that point was he was going to be too busy to do anything. And then by the time you get to taxes, it would be the second year of his administration, which going into the midterm elections, didn't want to lose control of the House or Senate. Now, the thing that worries me today is that there's so much chaos out there right now, they might just go for it and say, hey, gee, we're going to lose the House and Senate anyway, so why not throw the tax reform in there and make those changes also? So please just keep an eye out. If you're not on our email list, don't hesitate to reach out, sign up for it. And also on the YouTube stuff, please take a look at that and punch those like buttons and subscribe to keep on top of what's going to happen with tax reform. We just don't know at this point what's happening, but you got to look at these things, understand what those benefits and pitfalls are. This slide just talks about real estate. I love real estate. Like I said, I'm not banking on it going up. I'm always looking at something. What can I do with it? Increase the value, take care of things. The problem we're having is a lot of regions of the country now, at least on the left coast, we've got so much rent control, different things happening where if you look at a brand new building is exempted from some of the rent control stuff, but an older building is not. And the older buildings are the ones that should be exempted from the rent control stuff because they're those properties that need help. In today's world, if you're in Portland, for example, you can't afford to put the money in because you can't bump the rents. Even in between tenants, there's now some rent control proposals out there that would cap your ability to bump rents, even in between tenants, let alone having a tenant in there and what you can do. So, I mean, if you look at what I came to Oregon to do, 30 plus years ago, I just couldn't do it here. I'd be heading elsewhere, someplace where I could actually buy an asset, improve it, make it livable, make it something that people want to live in, and then put it back in that market. You can't afford to do that here. So I've got so many clients leaving this region right now and just wanting to go someplace where they have some right of ownership. But that's where we're looking at Section 121, 1031, other tax codes you might want to be aware of. If you've got a city or county or state, somebody wanting to take property from you, that would be involuntary conversion. That's Section 1033. It's great if you've got the ability to use 1033 instead of 1031. Do it. You've got much longer timelines. If it's a eminent domain type situation, you've got the same like kind rules 1031 has. You actually take receipt of the money. You don't have to spend all your equity. You've got just much more appropriate or attractive set of rules to work with if you can use 1033 instead of 1031. So why are we even talking about this? Why even consider 121, 1031, 1033, any of these different codes? The bottom line is you're looking at gain and tax and whether you have to or want to pay that tax. So understand that there's ways around these things, but we're looking at gain. Gain has nothing to do with property. Gain's a simple tax calculation. It's the difference between your adjusted sales price and your basis in a property. What's your basis in the property? What you paid for it, plus capital improvements minus depreciation. Now, each of those things, that purchase price, usually I have a little asterisk next to each of these because the purchase price isn't always a purchase price. Now, look at what I was saying earlier about Section 1034, the residential rollover that occurred before Section 121 came in 1997. So you had a situation where you had a basis carry forward with 1034. 1031 is a basis carry forward. You don't get rid of the gain. It's not a tax-free exchange. It's a tax-deferred exchange. So every time you do an exchange, you're filling out your tax people are going to fill out an 8824, which is a basis carry forward calculation. They're just calculating what the basis is in the new property versus the old one. So understand when you're doing those exchanges, you're deferring the gain, and unless you do, as I said, a swap till you drop, something like that. But the purchase price varies depending on how you got that property. If I gave you a property, your basis would be what my basis was. If I passed away and you inherited from me, you got stepped up base current market value. If I did 1031 into it, you got to look at what's been carried forward into that. That would be that initial purchase price calculations. The second one is the improvements. So I sit there every day, all day. I talk to people about what they paid for properties during the time they owned it, what they do with it, and so on and so forth, because I want to rationalize their decision whether they need to or want to do an exchange. I don't want to waste their money. So I want to understand what we're potentially going to save those people. So when we're looking at capital improvements, that's what we're talking about with the impact on that basis. So things that you're just working on, repairing, maintaining, those are probably going to be expensed items. You write those off. So anything you wrote off is an expensed item. If you didn't write off as a capital improvement, it's going to increase your basis. So I'll sit there, okay, you bought it for this. During the time you owned it, did you do any capital improvements? Oh yeah, I did all this work. Did you write any of it off? Oh yeah, I wrote it all off. Well, no improvements in that situation. So look at what's happening there and how that's going to impact whether it's an expense item or improvements. Depreciation. Well, what's the government's position on depreciation? I talk to people once again every day going through this stuff. I say, well, did you take depreciation? It's been a rental house for you. Did you depreciate? No, I didn't depreciate. What's the government's position? You should have, therefore you did. So it's really critical. Once again, great tax people are very important in your life. They're going to help you out. They're not cheap, but they're going to save you a lot more than they're going to cost you. And they're going to be looking at like this presentation and figuring out what it is. And you know, it makes a huge difference. If you've got a single asset with allocations different directions, how do you make those allocations? What does that do to the return on investment? It's really important that we have people in our life that are going to take care of us. So basis of purchase price plus capital improvements minus depreciation, you're going to take that number and subtract it from the adjusted sales price, so the gross net of closing costs, so brokers' commissions, title escrow fees, tax and legal fees, hour fees. As far as that matters, you know, it could be lender required repairs, whatever it is. You're going to have an adjusted sales price, subtract the basis from that, and that's going to be your gain. All right. So then most states, you're going to have federal tax and state tax on those things. Now there's a bold right in the middle of this page that says phantom gain. Now that's something that we dealt with through the 07-08 mess, and actually we had people who were dealing with it clear up until 2019, I think was the last mop up of that whole mess. So phantom gain is one of those things that hits people on investment properties. It doesn't on a primary residence. For the people that lost homes or had short sales of homes during that period of time, their primary residence, they had tax. They weren't impacted tax-wise. They had tax relief for those situations. Investment properties, you don't. Phantom gain is a situation where the government is going to treat the debt on a property as the sales price in a foreclosure. Obviously you're looking at normal calculation of short sale. But what that means is if the debt exceeds the basis, you've got gain. So you could lose the property and still have the pleasure of paying taxes on that disposition, even though you lost everything. So what we did a lot during that period of time is we would end up stepping in pre-foreclosure. The taxpayer would give us the asset. When it was foreclosed, it would have been ours, not theirs. The date they transferred the asset to us starts the clock. And you're thinking, well, gee, they didn't have any money. Nothing came into the exchange company. How can you have tax? Doesn't matter. Phantom gain. So what they're looking at is like, okay, if I lose it to foreclosure, I'm going to lose this much money. I lose the property. I'm still got to pay tax on this phantom gain. A lot of times, I'll tell you what happens is that the tax consequence is actually greater than if they have to just come out of pocket money to go buy property. So in a phantom gain situation, the property gets foreclosed. We don't get any money. the taxpayer has to come out of pocket money to buy a replacement property. And what I'm saying is often the money they had to come out of pocket to buy that replacement property is a lower number than the taxes owed in a foreclosure. So that's just one of those things. Again, good tax people, important, but don't assume just because you lost it, there's no tax hit. On income properties, you really need to understand what's going on, be aware of that. Section 121, the Universal Exclusion. So what does it say? As I say, it came in 1997. And what it says is an individual has a $250,000 exclusion on the sale of the primary residence. A married couple would have a $500,000 exclusion on gain. And to qualify, you have to have lived in the property for an aggregate of 2 out of the preceding 5 years. You can do this once every 2 years. Now, you can have multiple sales as one action. More often than not, we don't do that. What I mean by that is that you could have a house in the adjacent land that was in your backyard, let's say, and you could have a sale of the home and the dirt to somebody else. And as long as both those sales occurred in the right timelines, you could have those 2 sales as the sale of your primary residence. So even though the code says 1 sale every 2 years, it's not an absolute. Good tax people, once again. More often than not today, what we're doing is we're slicing off that adjacent property and treating that thing as 1031, and then the primary residence goes to 121. So you're just looking at a situation, what you really want it to be. And you've got a situation where 121 applies to any property that fits that 2 out of 5. It's not what it is at time of disposition. 1031 applies to only things that are held for investment at the time of disposition. So if you have a property that was your home and you moved out of it, let's say 2.5 years ago, well, you got 6 months to sell it, still using the exclusion. And so you can take the exclusion, the overage would go section 1031 if you needed it to, if you had that. But you've got to understand those timelines. Now, if you've got a home and you've lived in it for 18 months and you've got substantial gains and there's no hardship, well, you better talk to your broker about it and understand you don't want to sell it within, before you've eclipsed that 2-year period. So it's really important, these timelines. Understand that 121 is not an elective proration. It's really something you've got to look at it. If there's a hardship, and we've got lots of people once again with hardships right now, so you talk to your tax people, you're probably going to be entitled to a proration of 121's 250 or 500 if you've had to deal with some COVID stuff, or maybe you've got job changes, financial, all kinds of stuff. But you talk to your tax people and look at what your situation is. Their job's to keep your money yours. 1031 applies to investment property. Now understand 1031 is 100 years old at this point. So it's been around a long time and it works very well. And I'll just say with either one of these things, there's absolutely no such thing as a dumb question. The dumb question's the one you don't ask, right? So if you got questions on any of these things, please reach out. But 1031 applies to what something is at time of disposition. Lots of misinformation out there. People say, well, you haven't held this property for a year, you can't do an exchange. Or the code says you got to hold something 2 years. That's not correct, all right? 1031 does not contain any stated required hold. There's a court case we're going to talk about in a little while where 4 months was deemed long enough. But really it has to do with your intent and what you're doing with it. So dealer status stuff, like I said earlier, we hear about all the flipping property stuff, and that does not fit 1031. That's property held for resale. So, how do you fix that? How do you change it? And that's where we go back to, like I said earlier, with the modified flips, where you're buying, fixing, holding, seasoning, and then converting it, selling it in the future, exchanging out in the future. But 1031, we lost personal property in 2017's tax reform. We used to do I love cars, so we used to do lots of real high-end cars, lots of fun with that world. Had somebody make $6 million on a car in 2 years. That was pretty wild, a McLaren F1. But anyway, we've lost aircraft, cars, all that stuff, businesses we used to do. And we lost those, I would say, because we've got the opportunity zone instead. So the OZ, if you want information on that, you can take a look at our YouTube channel. I've got a pretty good series of presentations on opportunity zone. So if you sell a business today, that if you want to defer some of the gain and get into real estate, the opportunity zone process would allow you to do that. So it's a good opportunity for people that are moving out of other assets into real estate. If you're going real estate to real estate, I don't really look at it as that attractive. It's sort of like a Roth IRA for context. What I mean by that is a Roth IRA, it's taxed money that's going to grow tax-free. And that's sort of what the OZ does. You've got a limited tax deferral into the asset, but then what you make on the asset is it's going to be tax-free, which is a beautiful thing. So take a look at that. If you're giving up something on real estate, you're looking for some tax deferral, or you've got a sale that's got, let's say, a real estate component and a business component, we can do the exchange on the real estate component. The business component could utilize the opportunity zone. So it's a nice thing there. But 1031's been around a long, long time. It really hasn't changed that much. And as I said, it's going to apply to real property, and that's why you're all on there today. So what are you selling? Anytime, so people ask all the time, when do I want you to think about the exchange? I'm going to tell you when you go to list the property. So when you contemplate a sale, number one thing you should do is go talk to your tax people, understand the tax repercussions of a sale, and then really look at what it is. But most of the time, you're going to look at these two tax codes. And as I said, primary residence is Section 121. To qualify, you just have to have lived in it for 2 out of the preceding 5 years. You can do it once every 5 years. You just take it's a straight exclusion. So you don't have to buy anything. The money goes to you. That's it. Done, done, done. 1031, totally different situation if you have actual or constructive receipt of the funds. So if you close a property, never touch the money, but you have the right to touch the money, you've got a tax problem. So we need to have the exchange set up pre-settlement. And you know, even after 100 years, it's amazing how many times we get a call a day after closing, a week after closing. And a lot of times people will hear about a reverse exchange, which allows you to buy a replacement property before selling your relinquished property. Well, once again, you can't buy it and take ownership of both properties or maintain ownership of both properties simultaneously. You can only own one or the other. So if you've closed a property without our involvement, you're done. That property is yours. You don't have the ability to exchange into it. So if it's a situation where you want to do a reverse exchange, buy first, sell later, we have to be involved pre-settlement on anything. So don't let things close without asking the questions. Understand what the property is or what options you have with respect to what you're selling, and look at these tax codes, use them to your best advantage. And we're sort of looking in the context right now of an asset either fitting 121 or 1031. But there's lots of scenarios where an asset could fit both tax codes. Here's a few examples of Plex: one unit owner occupied, one non-owner occupied. So if they're mirrored units upon a sale, the owner occupied unit would go Section 121, the investment unit would go 1031. Our contracts would read we're doing an exchange of a portion of the asset and go that direction. Farm, the farmland, the home and the farmland, the working land. One sale allocations, different directions once again. Even a home with a home office. Now, think about this. I mean, this last year, how many people out there are working from their home these days? And you might be doing that. You might have spent a fair amount of money just getting your home set up for it. Now your tax people, it's all tax planning season right now, and you're saying, gee, maybe we ought to treat this thing as a home office for tax purposes. And I was actually on the phone with my tax people earlier today, and we were talking about a couple different things. And I made the comment, you got to understand that anytime there's something like, for example, a home office, there's a tax benefit, there's probably a pitfall someplace else. Now, so the home office, you treat it as a home office, you depreciate, you take depreciation on it, and so you got a nice little write-off, you're using it anyway. Now, if you've done that and you've treated that home office as such for more than, let's say 3 out of the last 5 years, now you're in a situation where that portion of your home has to be exchanged. You're going to pay tax on it. So be aware of that. And even if it was less, let's say you just treated a home office for a couple of years, so you still have the whole thing fitting the 2 out of 5, you're still, upon disposition, going to hit with depreciation recapture. So understand, once again, if there's a benefit, there's potentially a pitfall someplace else, and that's one of them. Now, what's the solution? The home with the home office? We just do an exchange of that home office component of that property. So who makes those allocations? Once again, it's pretty clear. Your tax people are going to do it. That's what they're basing depreciation on. They've got the allocations made, but you may or may not be shocked that so often we get involved with a transaction and nobody's looked at this stuff. So you can do your own tax work. I wouldn't do it if you've got income property. You're probably costing yourself a chunk of money. Don't look at the cost of time with a good tax consultant. They're worth their weight in gold. So like I said, their job's to keep your money yours. They're going to look at a variety of things. We're going to love talking with them because we're going to go over different things. If there's some issue that comes up that doesn't quite fit or we might have a potential problem with, we're going to send you information and then have you talk to your tax people. So I just, when we're looking at good tax and legal people in these situations, you don't want to pay somebody to learn. You want to pay somebody that knows this stuff. And there's lots of great professionals out there that do. You just got to ask for those people. So this page is all about looking at what you have, understanding, gee, what it is, what you want it to be, and maybe it's both. Maybe it's 1031, maybe it's 121, maybe it's both those codes, and there's many scenarios where it is both those codes. Conversion of property. So the next thing, like we said, you can take a lot of times somebody's first investment property was their primary residence, they moved out of it. That's a conversion. Maybe buying a property as a 1031, converting it to a primary residence. How do you do that? Define a primary residence. Let's just look at that one. I mean, you've got, where do you get your utility bills, voter registration, driver's license, all that stuff. I mean, where do you spend most of your time? But it's not strictly defined. We've got a fair number of people. I'm talking to you today from Portland, Oregon, and it's a lot of people here just disappear in the wintertime. They're down in Palm Desert or Arizona or Florida, wherever it might be. They might live in those places for more time than they live in Oregon, but they still treat Oregon as a residence for whatever reason. So you've got to look at it and understand also your tax people for estate planning purposes. I'll just say, well, Oregon, for example, doesn't follow the federal guidelines on estate tax, and so they're going to hit you with tax here. It's actually, if you've got a higher net worth, you're actually way better off passing away in California than Oregon. So you've got to look at this stuff, and the good tax people are going to work with you. Their job's to keep your money yours. So use those people. But when we're looking at converting assets, we're always looking at, well, how long does something need to be held before you convert it, or what's going to be a satisfactory seasoning or holding period? And really that, once again, does not exist. If somebody's pushing me for timelines on any transaction, I'm gonna say I'd like to see somebody hold a property for a year, and that's based upon a couple different factors. One, the break between short and long-term tax rates on assets held for investments 1 year. Two, it's been proposed a couple times. Now, we're looking at conversions and seasoning. What I say about the universal exclusion earlier, you've got a 2 out of 5 requirement, but if you acquire a property, via 1031 and convert it into a primary residence, let's say, and this court cases, Patrick, we're seeing court cases happened, a few years back now. Time flies when you're having fun, 2012. But I mean, people bought a property via 1031, converted the primary residence, documented listings, showings, argued that they could no longer afford to keep both their primary residence and this new income property that's vacant. So, they end up moving in the income property. After 4 months, got audited, went to court, prevailed in court after a 4-month hold. I'm not going to tell you 4 months is long enough. In this court case, it was deemed long enough. I'd like to see a year. And as I said, it's based on 2 factors. One, the break between short and long-term tax rates, and it's been proposed a couple times. For those of you out there that say, gee, the code says 2 years, it does not say 2 years, all right? It says 2 years on a related party transaction, and even in related party transactions, it's not an absolute 2 years. So if you've got, let's say I swap properties with my brother, in that situation, typically related party transactions, it's okay to sell to related party, not to buy from one, but the exception from buying from one is that if both parties are doing exchanges and both parties hold their replacement properties for no less than 2 years, then that's fine. Now, the fine print of a related party, that section of the code also says, well, their intent, unless you had the genuine intent. Well, how do you prove that? I don't know. I mean, I just wouldn't hang my hat on it. I just say, if I'm swapping with a related party, By the way, related parties, lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. Those are all related parties. So anytime you're transacting with one of those related parties, you've got that. I'd just say, look, plan to hang on to the thing. Each of you hang on to the replacements for no less than 2 years. Or, as I said, you could sell to a related party. You just can't buy from one unless they're going to do the exchange and hold for 2 years. So seasoning, it's really up to your intent, circumstances. As I said, with the prorations on Section 121, 1031, we had lots of people bought property last year, and with COVID, there's different on the West Coast. Once again, you've got a lot of government officials that just don't seem to respect an owner's obligation to pay a bank, and they don't want to take care of those taxpayers. They'd rather take care of the tenants and end up torching the taxpayers. So unfortunately, we've got a number of people this last year that have had financial difficulties. They're going to continue to, depending on what their level of relief for COVID is. And so you bought a property and your tenant stopped paying you 2 months after you bought it, and you can't afford to keep it. Could you sell that property and exchange out of it again? And I'm going to tell you, yes. And that's a hardship situation. You're going to lose the property or do another exchange out of it, get into something else. So unsolicited offers, hardship, those are situations where you can really do an exchange, justify an exchange with a shorter period of time. But you want to have these conversations with your tax people, make sure they're comfortable with what's going on and how you're going to do it. But converting assets back and forth, we have many people with gains well in excess of 250 or 500. We tell them to move out of the house, convert it into an investment, season it, and then exchange it. They still are entitled to exclusion. They're going to exchange the overage. We have many people as an end game want to buy a property, convert it into their residence. Well, that's something that works very well, not as well as it used to, for the reasons stated on the next page. But so I may as well hit it right now. If you buy a property via 1031 and you want to convert it into primary residence, you can do that. And the government's given us guidelines. So if we go back to 97, when the 250 or 500 came in, we had like a 3-year period where we had lots of people buying properties via 1031. They'd move into it, season it as a primary residence of 2 years, dump it, take the exclusion, and get rid of all the gain. And that was maybe after a 3-year hold, let's say. If they bought it, maybe held it for a year, then moved into it 2 years, that gets us to 3, and they sell it, turn it, take the exclusion. I can't remember, right around 2000 or so, they put a five-year required hold on a property. So if you buy a property via 1031, convert it to a primary residence, if you sold it within 5 years of acquisition as a fully taxable sale. That slowed that process down dramatically, but it didn't stop. The government didn't like that. So what they did in 2008 is put in the Housing Assistance Tax Act of 2008, which there's got to be a college class just out there, or a political class just on how to name a bill, because I mean, these titles are insulting to anybody that has a brain in their head. You look at what these politicians put out all the time and what they call these things. So the Housing Assistance Tax Act just sticks it to you, the taxpayer. All right, what it says is you can do this. You can acquire a property via 1031. You can convert the property from investment to residence. If you sell it inside 5 years, it's a fully taxable sale. Furthermore, if you hold it for more than 5 years, you are entitled to the application of Section 121, but only on a limited level. So what it says is that you are going to be allowed a proration of Section 121's 250 or 500 prorations per the time the property's been used via both the qualified use and non-qualified use periods from January 1, 2009 to the date of conversion. That's non-qualified use. So the time that you've lived in it is qualified use. So if you had a dozen years of non-qualified use and 2 years of qualified, you got roughly a sixth of the exclusion. So these are pretty convoluted formulas. I have no idea how they come up with these things. It's sort of like the identification rules and how ludicrous they are. But anyway, this formula right here is just another reason you need good tax people, because you got to talk to them, understand what's happening with it. But on the bright side, anytime they put rules in place, it ratifies a process. So by them putting a framework in place, giving us a path to walk, we know that this is something that's justifiable and valid and doable. It just slows things down. But the way I look at this Housing Assistance Tax Act is that this is the law situation. You are not going to be able to just buy a property, hold it for a few years, dump it, take the exclusion, get rid of your gain. Use this if you plan to buy a property you plan to live in for the foreseeable future. Don't do it if you think, hey, I'm just going to get the full 250 or 500. That path is gone. Basics, 1031 basics. Okay, you've been in my classes before, you've seen these. I like simple. I'm going to go through these basics, get us on the same page. Then I'm going to finish up with some examples, and that'll be it. But cornerstones, something's got to be given away, something's received. As far as you're concerned, you're selling and buying. Most state forms, the broker forms, have some type of boilerplate 1031 verbiage in them. I will warn you against just put it this way, a check the box provision, 1031 cooperation provision. If you check the box, that's going to make it a term of the transaction. Let everybody know escrow's not going to close that deal unless that's taken care of. If you change your mind, the problem with checking the box is that you've got to now provide an addendum to make that change, and you might give somebody a way out of the deal. So I'm sort of the opinion, I like good old-fashioned 1031 cooperation provision, something along the lines of, buyer agrees to cooperate with seller's 1031 tax deferred exchange at no additional cost or obligation, or buyer agrees to cooperate with seller's, ability to do a 1031. Not saying you're going to do it, but you got the option to do it. On the acquisition side, you want to have. So on the sales side, the reason I'd like you to have something in there is because if nobody tells escrow that it's the term of the condition of that transaction, how are they going to know? They could close the deal without you ever getting it set up, even if they know how to do the exchange. It's not their job to take care of things outside the scope of that contract. So if you're concerned about making sure it's set up, a lot of the forms now are they just give the writer the option to do the exchange, but there's not even a box to check, and it's just giving you the right to do it at the 11th hour, but it's not saying anybody is doing it. And I just think that that's potentially an issue on the relinquished property side. On the acquisition side, if somebody's asking us for money to buy a property, we're not going to give the money out unless it's set up as an exchange. So I don't worry about it as much on the acquisition side. Most contracts are assignable unless they specifically prohibit assignment. It's going to allow us to do what we need to do anyway. But one, it's got to be an exchange. The exchange is between the taxpayer and us. It's not between the taxpayer and the buyer or the seller. So phase one of the exchange, you give us something, we sell it to the buyer. When you tell us go, we just need your contact information. So name, address, phone number, email address. We want to know who's handling the escrow number, and phone number. We're going to get a hold of escrow, get a copy of the title report, the purchase sale agreement. We're going to create the exchange agreement, an assignment agreement, which is actually the document allows us to step in, assume all rights and obligations of our taxpayer as a relinquished, as a seller of the relinquished property or buyer of the replacement property. But it's going to allow us to do what we need to do. Escrow instructions are going to go out, and a copy of the fee schedule. You, the taxpayer, are going to get copies of everything in advance, so you don't have to worry about it, one, being set up, but two, any surprises. I mean, for years, my dad always joked every time he'd go to closing, he's like, how come I'm seeing these for the first time? 100 pages there, I've never seen them before, da, 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 da. So I always think of him when we're sending paperwork out in advance, so you've got the ability to look at this stuff before sitting there in front of your escrow officer trying to figure it all out. So think about it earlier rather than later. But it's got to be an exchange. You give us something, we give you something back. Make sure as soon as you get escrow open, you get a hold of us. But ideally, when you go to list the property, at that point, talk to us. Make sure that we're sort of all on the same page on that stuff. And do not. You can go out and find the replacement property. You can make the offer, put earnest money down, pre-disposition. All of that's fine. Just do not close on anything before our involvement. So, one, you give us something, we got to give you something back. Two, what's relinquished and received have to be of like kind. Like kind refers to the nature of the investment or in the form. Three, we got to satisfy what we call a napkin test. And finally, we've got to have continuity vesting. So we look at that exchange. Once again, you're going to give us something, we got to give you something back. And exchanges, you understand an exchange. My first exposure to 1031s was that my father was a doctor. He actually had two patients that were had different exchange companies. This is in the 80s, early 80s. So that was a very, very unique situation. But you know, he was selling a property, and they said, "Don't do that. Do an exchange." And he's like, "Okay, how do I find somebody that has what I want? I have what they want. It's mutually beneficial." Very rarely does that happen. Yesterday, I was on the phone with somebody that were exchanging one of their properties into a larger property, Tennessee in common deal. And so he's picking up a piece of this other asset. And, you know, in his situation, we are just doing a swap, pretty much a swap agreement. If you look at consideration, if you look at the stack of items, assets as consideration for any purchase sale, it doesn't say total cash paid. You know, it could be a variety of things. So that swap yesterday I was working on, really the purchase sale agreement is just showing that the purchase, the down payment is the property, and then they're taking it subject to the existing financing there. So so we're going to provide a swap agreement to further you know, support what that agreement's saying. And once again, the person with the smaller property, they're able to go into the new property without a three-way exchange. The seller of that bigger property, if he or she wants to defer gain, they're going to have to set up an exchange to receive something more. But it could be a swap. A delayed exchange means that delayed exchange, a three-way exchange is what we typically see today. You're selling, you've got 45 days from settlement to ID, 180 days to get it done. Reverse exchange, we're going to buy first, sell later. From the date of acquisition, you've got 45 days to identify what you're relinquishing, 180 days to do it. Improvement exchange is really the same structure as a warehouse replacement reverse exchange, which means we're going to create a limited liability company that takes ownership of the new property and does the improvements, conveys the improved property back to the taxpayer. Warehousing is any time that we're taking an asset and sitting on it for a period of time. For example, I just gave you the scenario where that property was being used as consideration for the purchase. Well, what happens if that seller didn't want that property? Well, we just warehouse it. The property would come into the transaction just like cash does. Cash isn't like kind. That warehouse, you know, that building would come to us. We're going to create an LLC to hold it, and then we're going to do something with it. And it's just, when we use notes, for example, seller finance can greatly complicate a transaction because that note typically represents equity in the exchange. And the next thing we're going to talk about is the Napkin Test and value and equity requirements. But anytime we're receiving something that the taxpayer doesn't want or doesn't want to pay tax on, we're going to have to use that asset somehow, whether it's a note, whether it's a car, it doesn't really matter. In this warehousing scenario, you take a building as consideration, you don't want the building. If we gave you the building, you sold it, you didn't hold it for investment. So what happens is we create the entity, the building's held by us, we sell the building, now we have all the cash to complete the exchange. So that's just an example of a warehousing transaction. Another deal that we're doing a fair amount of, anytime we're aggregating a number of smaller properties into a large one, we might have a situation where we have to do what we would call a blended exchange. So a blended exchange means that you might find the perfect replacement, and this market, as we've discussed, is so hot right now that we're doing many, many, many reverses, because it's not a problem to sell stuff, it's hard to find things. So people just don't want to have a problem where they're trapped, they've sold, they can't get anything. So we're doing many reverses right now to get away from that situation. But you know, in that reverse, it's always a question of financing, how much the person has to put down versus what they expect to net, and so on and so forth. I think next month we'll probably be doing a class just on reverses, because we've just got so much demand on that topic right now, what's going on, the financing that's required and everything else. But the issue with a reverse is the taxpayer cannot own both the new and old property at the same time. We have to warehouse or park one of them. So it's just a question of which one we're going to warehouse or park. So again, before you ever close anything, talk to us. Talk to your tax people, understand the tax liability of a disposition, and make sure if it's something where you think you need to do an exchange, that we're involved before the closing, not afterwards, because afterwards we're done. We can't fix it. Like-kind requirement. lots of people through the years, lots of misunderstanding on this. People are told all the time, you got a house, you got to get a house. You got land, you got to go get a land. And there have been proposals through the years that like kind would be a true like kind. If you look at like kind in Section 1033, for example, if it's a let's say a fire, some type of not a condemnation situation, but some other type of conversion, then you're going to have a true like kind, similar in service and use. But if we're looking at 1031 or a 1033 and under a municipal condemnation, let's say, then you're looking at this like kind requirement, which refers to the nature of the investment rather than form. Any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. So you can go from land and apartments, office buildings, strip malls, places to beach. All those things are going to be of like kind, a place to retire into. You're just going to buy it, hold it for a period of time, and convert it. If you look at that 10 o'clock button there, build to suit 30-year lease, that one's important because a 30-year leasehold interest in real property or a lease with extensions to 30 years constitutes ownership of real property too. So just be aware of that one. And that's another let's say a build to suit, leasehold improvement exchange is another opportunity that's out there. We're doing a lot of right now, but if you got questions on what that is, you can reach out to us. The napkin test. People come into me every single day and say, I have to replace the debt in an exchange. You don't have to replace the debt in an exchange, all right? Now, 1031, I'll say first off, is not all or nothing. So what the napkin test says is that you must go across or up in value and equity between the relinquished and the replacement property for total tax deferral. Understand, number one, 1031 is not all or nothing. So if you want to pull some money out, do it. Every dollar you spend more on something than you want costs you a dollar. So if you don't spend it, maybe it costs you 40 cents. So you're better off not spending the money than spending more than you want for some. I've actually had people ask if they should pay an extra $5,000 for a property just because they have that, they're going to get the 5 in boot. And I look, absolutely not. You're spending 5,000 more than you need, or maybe your tax hit's going to be 2,000 of the 5,000. Well, where are you better off? So just look at your situation, understand what your total gain is in a property. And 1031, you're going to elect to defer as much gain as you choose to defer. So every dollar spent over your tax basis represents tax deferred gain. Once again, we've had a crazy year here, and we've got lots of people that have lots of things going on, and maybe you've got a situation where you've got some job or life changes that you want to take care of, and you don't want to fully satisfy this exchange. Buy what you want to buy. Maybe you're buying something, you're going to retire and it convert it. We've got an example slide. We're going to talk about that. 1031 is not all or nothing. You're going to defer what you choose to defer. And as soon as the boot's anything you receive that's not of like kind, as soon as the boot received exceeds the total gain, there's no benefit to the exchange. So if you've got 100,000 in gain and you want to pull 110,000 out in boot, there's no benefit of the transaction. If you've got 100 in gain and you want to pull 50 in boot, well, you're deferring gain on 50, you're going to have tax exposure on the other 50. So understand what's going on, what's happening. One final comment on debt on an asset. Let's say you go out and buy an investment property and you pull money out of your home. You use a home equity line of credit, a HELOC. So you pull the money out instead. So instead of financing the new property, you use the HELOC to buy it, even if it's just for the down payment, let's say. But let's just treat it as a HELOC acquired investment. When you go to sell that property, what's the debt on that property? That HELOC is not debt on that property, it's debt on your home. So the HELOC represents equity in that property. So this is I'm just giving you an example of why to talk to somebody like us before things are happening, because we're going to tell you to do some different things. You got that HELOC on there. Maybe you want to try to put some permanent debt in there, change things. There might be some other opportunity out there too that we can talk to you about. But understand when you use the HELOC, I'm not saying don't do it, just understand what that means. That HELOC is debt on your home. It's not debt on the income property you use the HELOC money to buy. So when that property goes away, you probably want to pay the HELOC off, and you're not going to be able to do that without tax unless you make some change in that loan. So once again, you've got to understand, hey, there's an over here, cheaper money, easier to get. I've got the line in place. The downside is on disposition, it might be looked at differently and it might prove harder to get the money out. So just look at it, talk to the professionals in your life, and really figure out where you want to go and ask those questions. But the Napkin Test says across or up in value and equity, debt can go away two ways. Debt can go away by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding cash. So what happens in recessionary times? We've got a lower loan to value, lower LTV loans, and we typically have a situation where maybe property values are eroding, so the equity is decreasing. So now you go to complete the exchange and you've said, gee, now I don't have the equity I need. The loans aren't going to allow me to get where I need to go. So do I need to pay the property that I'm selling off if I don't want any debt on the replacement? Do I need to pay it off before I sell it if I don't want debt on the replacement? Do I need to pay down the debt on the relinquished so I can have a lower loan to value on the replacement? None of that is necessary, all right? You're just gonna add cash. You can always add cash to the acquisition. So if you gave up a property that was, let's say 90% loan to value and you had to buy the new one, as long as the value number is there and the value and equity numbers are net of closing costs, by the way, you're going to be fine. So if you sell it 100, let's say you just say the conversation, you got 10,000 in closing costs, you're going to need to go buy a $90,000 replacement property for total deferral. What happens if the perfect one's 80,000? Well, you pay tax on the 10,000 spread. Maybe you have losses elsewhere to offset the gains. Once again, back to you're going to work with your financial advisors, you're going to work with your tax people, come tax return time, or not tax return time, before year end. Do some year end planning. Don't talk to your tax people the first time, April 14th. Talk to them before the year's end and make sure you're going where you need to go and they're taken care of. Give them the opportunity to keep your money yours. Ask those questions. But the italicized statement in the middle, you may offset mortgage boot with cash. You cannot offset cash boot with additional mortgage. That's critical. So you can always add cash to a transaction, but if you want to pull money out, you're going to pay tax on the money coming out. Continuity vesting. About 40 minutes ago, I said the biggest headache in an exchange is time, and I said the second biggest issue is this. So the reason continuity vesting is so problematic, and I gave the example of let's say Oregon. Oregon's not a community property state. Let's say you start off your first investment property, your home, you got a kid, you move out of the home, now it's an investment property, you sell it, roll it into via an exchange in the next property, and the next one, the next one. You keep doing this over time. Now you've got, let's say 3 or 4 properties. You go and meet with your lawyers and they say, gee, you know what? You got to shove these properties into a limited liability company. Now you've got these properties, just isolate you from potential problems there. And that's not a bad idea. But if you're talking about 4 units or less, when you go to buy a property, you're talking about more expensive money. So the reason I brought up Oregon is that partnership interests are specifically prohibited from 1031 treatment. So I'm talking corporations, legal partnerships, limited liability companies. Now the entity can do an exchange, but the members or the shareholders, if they want to go different directions, cannot. Okay, you've had to break the entity pre-disposition or after acquisition. The slang of those two is a drop and swap or a swap and drop. But that issue gets to be a problem as easily as this. You've got a husband and wife properties, start with 1, got several, now they got 5. The lawyer says put them into an LLC. You do that, you give it up. Now you're going forward. You want that cheaper money. So now you gave up the property as members of an LLC. The LLC gave up the asset. You're going forward, you got to buy a new property. Oregon's not a community property state, so husbands and wives cannot go in and out of a limited liability company during the exchange period in a non-community property state. So we have to give you the new property in the LLC. You can't buy it personally. So what's your choice? Break the entity predisposition, go forward, buy individually, and then put the property in the LLC. Make sure you talk to your finance people because there's typically something in the loan covenants prohibiting a deed into the LLC, but they're going to tell you to do that anyway. If we're looking at a community property state, that's not a problem. You can go in and out as spouses in and out of the LLC. So this vesting piece gets to be very problematic very easily, and that's why we want to see, we want to have that conversation very early with you so we can eliminate the potential for problem here. This is a structure. The taxpayers up top, they give us a property. That's step one. We sell the property to the buyer. The money comes to us. Step three, the deed actually goes straight from the exchanger to the buyer. We then, so phase one is completed. When we sold that property, we now buy the replacement property. It runs through us, and then we give it back to the taxpayer. The deed on that replacement property goes straight from the seller to the exchanger. If we're doing reverse exchanges or improvement exchanges, we are in the chain of title. We have to take ownership for periods of time. Those are warehouse transactions, but this is a basic delayed exchange. Something's given to us, we have to give something back. That arrows 1 and 6, those are the arrows that are so critical. Those are the arrows that we're looking at saying, okay, that's where the napkin test applies. That's where the like-kind requirements apply. That's where all the nitty-gritty happens. But anything that's happening on that bottom level is stuff we're dealing with. You know, they gave us a property. Maybe we got, as I said, a warehouse transit. They got a property. They got a boat that they you know, as partial consideration. Well, maybe they want the boat. Well, so we just give the boat to the taxpayer. The taxpayer would be, in effect, buy the boat from us. So the money's in that transaction to keep them totally deferred. Now they have the boat. Now I like boats. So anyway, as I said, this bottom level is all the things that we have to do. Those arrows 1 and 6, that's what's really important for the taxpayer. They're giving us something, we got to give them something back. Timeline's 45, 180 days. Both start simultaneous at settlement. They go very quickly. Don't wait around. As I said, when people ask all the time, when should I start looking for replace? I'm going to tell you when you list the property. Start immediately or before you list it. I've got lots of people today coming to us finding properties before anything ever, you know, is happening, and that's why we look at the reverse, and maybe we use the reverse as a fallback and not a primary course. So you just ask for what you feel you need to fit these timelines. A comment on the 180 days. It says 180 days are the due date of the tax return. So if we start your exchange late in the year, don't file your return until you've completed the exchange. Identification rules. Okay, these rules are absolutely ludicrous, and you know, I always used to joke, is I don't know what they're doing, drinking tequila or something when they're coming up with these rules. But you've got 3 different identification rules. Most people are aware of the 3 property rule, and they think that's the one that applies to everything. That's not the case. You've got 3 different ID rules. Each rule works independently of the others. You only have to meet one of them. All right. First option is up to 3 properties of any value. So name 3 or fewer, you're fine. They could be of any value, wide open, change your mind anytime up until midnight the 45th day. After the 45th day, you're stuck with one of those properties. And what says, so identification needs to be an unambiguous description. You need to receive substantially the same thing. Unambiguous could be a common address as long as it includes city, state, zip. If you're IDing a condo, it's got to be a specific unit, not a unit of a complex. If you're buying half of something, you need to state you're buying half of it. So if you're buying tenancy in common with other people, ID the portion you're going to buy. If you're buying into a Delaware statutory trust, let's say, or institutional TIC, you need to once again specify the piece that you're getting. All right. So 1, there's no cap and value. You're just limited to 3. 2, you can ID any number of properties. Total value of the property's ID can't exceed 200% of the relinquished property's value. What are properties worth if they're on the market? Listed, are they worth what they listed for? Or are they worth what you're going to pay for them? What if they're not on the market? What are they worth? So obviously you've got a valuation potential issue there. I'm going to say, put in there what you're willing to pay for it, because my youngest brother's an MAI appraiser, top of the heap in the appraisal world, that designation. And, I've asked him before, how do you know when you've done the right job? He says, well, it's pretty easy. Nobody's too happy or too mad, but you're always looking at highest best use for things. So you've got to understand those valuations. They're not necessarily stated anywhere. You've got to put the numbers down. But you can ID any number. Total value of the property's ID could not exceed 200% of that relinquished property's value. Third option, you can exceed 3, you can exceed 200%. You got to close 95% of the aggregate value of all properties ID. You're closing everything you identify. Very difficult to do. I'd stay away from that one if you don't need to work with it. This slide, when can I get my money? This is very, very important right now. As far as getting money out of a transaction, let's say you set it up and you don't want to complete it, or let's say you didn't find anything that you want and you want to shift gears and throw your money in the opportunity zone situation. And OZs are being marketed as fallbacks. Well, they are and they're not. I mean, you've got to understand when you've got access to the money. An OZ requires you get the money into it within 180 days of disposition. What's a 1031 say? 180 days. You can only get your money out of an exchange when you've purchased everything you have the right to buy. So if you're getting that 45th day and you haven't found what you want, don't just put a property on there as a just in case. Because if you do, and you decide you don't want it, or let's say after the fact you find something you really want, your broker finds something on day 60, and you identify these other properties on day 45, I can't give your money till day 181 in that situation. The OZ, you got to get access to. So when we get to the 45th day today, it's critical that you really, you're either totally committed to completing the exchange or don't at that time. But do not just throw a property in there if you're not positive you want to work to make that purchase, because if you do, like I said, then the money's with us till day 181. Otherwise, even if you turned in an identification prior to midnight the 45th day, as long as you rescind that prior to midnight the 45th day, that would be fine. In game swap till you drop, we talked about that. Exchange into a retirement residence. I alluded to it, didn't really cover it. So your question, and we look back that recent court case where 4 months was deemed long enough. I'd say a year, at least different tax years. Anybody that's telling you more than a year is probably thinking related party transactions. So, buy the property, hold it as an investment, move into it. Do not sell it within 5 years of acquisition. Don't even do this unless you're planning to stay there for the foreseeable future, because that Housing Assistance Tax Act just really doesn't give you much of a benefit at all anymore. Exchange until it makes tax sense. Maybe you're making a lot of money now, and maybe next year you don't. Maybe you've made a lot of money this year. Maybe you've got Wall Street losses that can offset the gains. So you're looking at a situation where that's when it makes tax sense. Talk to your tax people this year. Plan ahead. Understand where you are, what it's going to cost you this year versus doing something later. That's what I mean. The problem is dollars are going down in value, but taxes are going up probably. Installment sale, they're actually the next ones, exchange and passive investments, DSTs, Delaware Statutory Trust. If you're interested in more information on that, once again, go to our YouTube channels, Equity Advantage, DSTs. There's 2 different series on DSTs in there, 2 different brokers that specialize in that space, and you'll hear what they have to say about those assets, what's going on there. Installment sales. Know what's involved with that. Understand on installment sale, they're great. I mean, if you sell a property, put the money in the bank today, what are you getting on that money? Nothing. So an installment sale can be a wonderful end game for you. But be aware, if you're selling an improved property with debt, you're going to have tax exposure and debt relief and depreciation recapture in the year of disposition. A lot of times people just think they're paying tax on principal payments, and they don't understand that. So if you sell and do a seller carryback, you better get enough to pay the brokers, title escrow, all those closing costs, plus the tax on depreciation recapture and debt relief in the year of disposition. So an installment sale is going to give you the income over time. The downside is what happens if the buyer defaults, you're going to get the thing back. I've had people that we've done it like 3 times. They sold to somebody and they default and they end up getting the property back. If you're doing an exchange, you want to do an installment sale and you still do an exchange, talk to us. We've got ways to handle those things. A structured sale is just an installment sale that's institutionally structured. It evolved out of structured settlements. Basically, the money goes to a third-party assignment company that assumes the obligation to pay and then pays you over the term that you choose to make that happen, which can be very good. Deferred sales trusts are similar to that. Work in a similar manner. Charitable remainder trusts, CRTs. That's if you've got a charitable entity that you'd like to give a property to, you can get a nice benefit by using a CRT. And then gifting of items. A lot of times we'll have somebody buy a property, maybe they've got 3 kids, they buy 3 different properties and they start gifting those properties. And an easy way to do that, by the way, is if you've got 3 kids, 3 properties, you're going to acquire the property, maybe shove each of those into an LLC, different LLC, and then you just do an assignment of membership interest over a series of years. And understand that when you're gifting, if you look at cash gift tax limits, this is once again 2021, you're at $15,000 per person per year in cash. But if you're transferring a minority membership interest or ownership interest in something, you can discount the value of that piece by up to 40% if it's minority interest. Once again, who helps you with that? Your tax people. Take advantage of them, work with them to get you where you want to go. But gifting's a great thing. And the reason I got to just caution you too, a lot of times we have people just deed a property to their kid. What'd you do? You just gave them all the equity in the property, which probably is going to trigger a big tax consequence for you unless you've done some estate planning to mitigate it. So talk to those people, understand before you ever transfer an asset to somebody what that's going to mean. A couple examples were done. All right, so situation where we had a person with a large property, a farm, and we had a sale in this situation. We had an allocation to the farmhouse, which went Section 121. The working land goes 1031. And so our contracts just read, we're doing exchange of a portion of this asset, and we kept all their money there. So once again, the farmhouse portion, they don't have to buy anything. They've got a straight exclusion on gain of 250 or 500. The investment portion is going to go forward via 1031, and they just need to go out and buy, property of equal or greater value and equity to that income property component there. And you're going to work with your tax people for those allocations. You probably want to work with them to sharpen your pencil on what that farmhouse is worth, take full advantage of the exclusion, and 1031 anything over that. So this is a situation where we've got somebody giving up a property, ultimately going to buy a retirement home. And so they didn't want a $3 million retirement home. They didn't want other properties. So they gave up a $3 million apartment complex, went out and bought a $1 million replacement property in the desert. And you're going, gee, that's a lot of tax. Yes, you have a boot of $2 million in this situation. So depending on where they lived and what the tax, it could be a chunk of money, $600,000, $700,000, $800,000 tax hit on it. But they bought what they wanted. And by buying at $1 million, their tax basis was $250 on what was sold. So they still deferred gain of $750,000, still saved them $250,000 in tax, even though they only spent $1 million of the $3 million. So don't get stuck thinking you got to fully satisfy anything. Buy what you want to buy. If you're the broker, help them get what they want. And people, their threshold on paying. I think the smallest exchange we ever did was like a tax deferral of $5,000 in tax, and the exchanger insisted on doing the exchange, and the exchange cost like $1,500. I wouldn't have done it, but hey, that person was actually a tax professional, and she just was outright refusing to pay anything, so she has to do the exchange. Now, on the other hand, I had somebody one time, this is probably 20 years ago, with $800,000 tax hit, and they just said, well, it's $800K, it's not worth completing the exchange for me. So I never make assumptions on our clients and what they're trying to do. I'm going to help them get where they want to go and do what they want to do. It's my job to sort of give them the options, the opportunities, and their choice of what they want to do. This is a great example of somebody with a primary residence with gains way, way, way beyond the 250 and 500. So this is a couple that lived in Los Gatos, California, that came to us over a year before disposition. They were referred into us by a law firm, and they had a $3 million gain. It's got $1 million tax at $3 million, and a $500,000 exclusion does nothing for you. So they talked to us. What we do? We told them to move out of the house. So they moved out of the house. They bought their new home. They held it for a year, seasoned it as an investment. When they did sell it, they went out and bought 24 different replacement properties, closed them all inside the 45 days. She was a CPA. He was an attorney. She did everything. She knew that she didn't want to risk a sale fail. So with the 24 replacement properties, we're looking at that 95% rule. So she just worked, got all those transactions done inside the 45 days, went from $1 million tax hit to no taxes, got 24 replacement properties and a new primary residence, all with this transaction. I think that's a win-win-win situation, but worked very well, very happy all around. Last example, I'm throwing you a curveball on this one. This doesn't really have anything to do with 1031s as a teaser to get you to come listen to one of our IRA classes, but this is just an example of what is possible with retirement accounts. Everybody thinks, well, you're stuck in Wall Street. That's far, far, far from the truth. This was an older couple who came to us, and they were wanting to go buy a mobile home RV park with their retirement accounts. They had two different IRAs, so we said, okay, we'll do what's called a checkbook IRA. We're going to move each of their retirement accounts into a new limited liability company, and that entity would own this park. and that would have allowed them to get the deal done, and they would have had a nice investment. Well, as we're working through stuff, they said, well, we want to manage the park, and we want to live there. We want to be the on-site managers, the resident managers. Well, all those things would constitute prohibited transactions in the retirement world. So we shifted gears entirely into something called a rollover business startup. And so instead of moving their IRAs into new checkbook IRA, we moved their IRAs into a 401k plan. We created a C Corp. The plan bought the corp bought the park, and this couple got a job, a place to live, and an investment, all with that one process. And I just think that's an amazing story, and it just got them where they needed to go. So never say never. Don't worry about asking questions. Know that we're available. Give us a call. We're happy to address those questions. And do it before you buy something or sell something. Don't do it afterwards. Ask those questions before anything goes away. After the fact's too late. So you've been the guest of Equity Advantage today. Thank you very much for participating. And so 1031exchange.com, that's our exchange company. IRA Advantage is our self-directed retirement company, IRAadvantage.net or .com. And then we've got a property listing site. If you've got property that you want to get in front of people, if you're a broker, you don't have control of stuff, maybe that's a pocket listing, you put something up on post 1031. If you're an investor looking for things, you can take a look at that site, and it's there for you. This is our social media page. Once again, if you are looking for credit hours for this presentation, reach out to see more at 1031exchange.com. Other than that, we look forward to talking with you in the future. Thank you so much for joining us today, and I hope you found it worthwhile, and I look forward to speaking with you soon. Thank you, and best of health to everyone out there. Take care. Bye-bye.